G'day everyone. Today I'm speaking with Jackson Denka. He's the founder and CEO of Azura, a DeFi trading platform primarily on Solana, but also on ETH, ARB, and Base. Thanks for coming on the show, man.
Yeah, thanks for having me. Nice to be here.
Can you walk me through the process of launching and building Azura and what you were kind of addressing in the market when you brought this thing online?
Yeah. So when we first started building this, we didn't have a clear idea for what we were actually going to do. I just sort of had this idea in my head where I knew, for instance, okay, FTX had just happened. This was not a crypto scam. This was just a basic, embezzlement scam. Not enabled by crypto, not unique to crypto. You could do it with anything. It just so happened to be in cryptocurrencies. And I realized, like, one of the things that was interesting that Sam did while he was running FTX was he lobbied really hard against DeFi. He lobbied very hard. He tried to get a lot of laws passed to regulate DeFi, to kneecap it, to get rid of it. And looking back after FTX happened, my realization was like, effectively, if what he had built was a decentralized exchange, what he did would not have been possible. He wouldn't have been able to do what he did. And then, I started looking at DeFi because the assumption was, okay, well, there's probably a lot of mitigatory stuff here. You could if you can have a more decentralized, more transparent, a non-custodial system, you could probably avoid things like this in the future. And then, sort of went down the rabbit hole. This is beginning of 23. And I realized that the user experience was like unbelievably bad. Really like early 90s internet bad. It was, you get a wallet, you connect all these dApps, there's different network standards, you have to get gas tokens, you have to, swap between all these different products. It's a mess. And, the initial thought was, why don't we just build something that fixes this somehow? But I had no wedge, there was no there was no exact idea for how to prescribe a solution to the problem. And it wasn't until the first Telegram bots started coming out in the middle of 2023. And I guess technically they'd been a thing prior, but it wasn't. It was like Unibot and Banana Gun that really were sort of like I guess it was like the aha moment for me, because these were the first pure applications in crypto that made a lot of money, right? Like for the longest time, everyone said, oh, all value is going to accrue at the protocol and infrastructure layer. Apps are never going to make money. They're not worth investing in. They're not worth paying attention to. And this was, this sort of broke that entire model. We were seeing 3, 4, 5-person teams scaling these businesses to tens of millions, hundreds of millions in annualized revenue in a matter of months. Again, as pure applications, chat-based trading products. And I looked at that and I thought, okay, well, there's clearly a demand here. It clearly solves a problem. It makes it easier to trade on chain. But chat-based trading is probably not the end state. I don't think this stuff is going to exist 5 years from now. So what's the end state, right? It's probably a web app. It's probably something that looks and feels like a traditional fintech application, something that looks and feels like a centralized exchange or whatever it may be. And then that was sort of then we had like the wedge. We're like, okay, let's support spot tokens on chain. Let's make the user experience like you would have with a traditional trading platform or with a brokerage or with an exchange or whatever it is. And let's abstract away all the complexity, have it work out of the box. And that was pretty much the start.
I remember using BonkBot like early 2024, and yeah, just thinking like, what the fuck is going on? Like, this is the way that I have to trade, simply because most of the desktop experiences for trading, this is specifically to do with soul shitters, but was just kind of useless. Like having to go on to Radium itself and like input the contract address into the thing and trying to prove swap. It was just fucking gross. So yeah. From a technical standpoint, what does it look like building something like this? Like, can you walk me through, without giving away any of like the secret sauce, like 7 secret herbs and spices as to what makes it happen, but can you talk through like the technical side of like bringing that out of just like, you have your competition is essentially these trading bot Telegram apps, but you want to bring like a chart interface into it and still have that kind of like tight spread, fast execution. How do you go about bringing something like that online?
Yeah. Well, we sort of like strip back the layers of what Telegram bots were, and effectively what we realized is all of these products, whether they're trading terminals or Telegram bots or whatever it may be, they are wallets. At the end of the day, they are wallets. The key difference is that with a wallet, you have this sort of unopinionated software. You have a browser extension, you can connect it to dApps. With the Telegram bot or terminal, there's no connecting to dApps. They are baked in directly. There's guardrails in place. There's like special bespoke code written for, making transactions faster on Solana, for instance. They're giving you best execution for pump fund tokens or whatever it may be. So it's effectively a wallet. That's really what all this stuff is. They are wallets with very bespoke, very high quality rails for integrations. Obviously, the scope of things you can do with this wallet that has manual integrations is far more narrow. It's a lot more niche, but of course it is higher quality for what you're getting. Like swapping on Phantom, for instance, you might have access to more liquidity because they're like this meta aggregator, right? They have all these different aggregators under the hood. They have all these different dexes. But when it comes to like speeds, for instance, or if you want real-time data, if you want to swap really, really fast, maybe not the best because, again, it's a more generalized product. But yeah, that was where we started. We're like, okay, let's build this wallet effectively. Now let's build a front end for it. Let's build an app. And we have to, the chief duty of these products is to read and write to the, read from the blockchain and write to the blockchain, reading data from it, setting transactions to it. So, for the actual like transactions, the swaps themselves, you just integrate, like say, third-party dexes. You read from the chain. We ended up having to build a data engine bespoke. We ended up having to build our own aggregator bespoke. Like we don't use a 1inch or a Jupiter. We built all this stuff in-house. We don't use a Bird Eye or some third-party data provider. We do that in-house. It was hard. It's hard. Yeah, it's tough. Now, of course, like with a Telegram bot, what's nice is you don't have to have real-time data. You just, it's like a point in time when someone like queries, say, a contract address or whatever. Maybe it refreshes on some interval. But the real difficulty was, how do you make this entire thing real-time, especially for a chain like Solana that's like 300 millisecond block times? That's where it gets tough. That's where it would get into like, I wouldn't even be able to tell you how it specifically works because it gets like so complex, but it effectively, wallet, front end, rails for executing, rails for data to be ingested and served to the user. And that's pretty much it boiled down. But yeah.
What was the reasoning for not, and I'm not sure if this is something that's like gated or there's fees, but what was the reason for not using something like Jupiter in the back end? Like just integrating directly onto Jupe and just like accessing liquidity there. What was the reasoning behind being like, nah, fuck it, we're going to like do our own aggregator in-house?
Yeah. It was somewhat out of ego. It was like, we want to own the execution rails. But there were some more like logical reasons for it as well. One of them was that if you are entirely reliant on a third party, then you can only develop as fast as that third party offers support for things, right? Like if we out of the box had only supported Jupiter, our entire execution was reliant on, say, Jupiter for Solana, we would have not had pump fund tokens until about a year later. So to own the execution rails means to have a lot more control over, like say, one thing we did was in November, my friend Bao had started DAOs.fund, right? Nobody supported DAOs.fund at first, kind of, it was very early. Because we had because we built our own rails, we could support it out of the box faster than anyone else. Now, of course, there are downsides, right? Because you have to upkeep these rails. You actually do like the manual labor of building effectively an aggregator yourself. But it's one of those things where it's an upfront investment that saves a lot of time and money later. You also get to avoid now, like Jupiter has fees, for instance. Now they have costs for querying their API. And just generally, like, again, out of ego, like it's nice to own as much of the stack as possible. But yeah,
I've actually been earning my little gems fairly diligently. Well, I was. This was when markets were actually good and I was trading. But like, for a couple of months there, I was earning my little gems pretty diligently. And this might be a question that you can't answer. So all good if you have to, plead the fifth. But, is that... Can you share what that might turn into for users? Give like even like a directional kind of answer of how that's going to work?
Yeah, for the end state of them, I'll plead the fifth. But one thing I was considering actually, that I'd mentioned to some folks really early on, but we haven't really gotten the time to get around to, was I wanted to sort of build an economy around these things. That would I think like one of the problems with points programs is that points are worthless until they're not. But there is no period in between that where they have some value, right? They are entirely worthless until they're worth something, right? Like with some of these other terminals, like people were racking up all these points. They're never giving you a token. Those are worthless, right? You are never getting anything. It's just a number. So what we were trying to figure out is we're like, okay, we don't know, like we don't have a specific time frame for what we're going to do with these things. We don't know when we're going to do it. We're not in a rush to do it. But of course, like we want to have an incentive program around using a product while it's so, early, while there's bugs with it, while there's issues with it. So we were considering building out effectively an economy for it, where effectively, like I think that point systems are flawed again in that they are valueless until they are valuable. There is something in between. How do you make these things worth something before they, convert into something else or turn into another thing? I'll leave it at that. But yeah, we were looking into effectively building like a small economy around them. The best words for it. Yeah.
Okay, cool. I remember that there was like a Wales market thing that was trying to like do OTC points sales or some shit during like the peak of the points meta, where everyone, that meme of like, fuck, I just need to earn more points was going, and everyone had the points program moving. You've got a new version of Azura coming soon. Can you tell me a little bit more about that?
Yeah, we when we released the initial version publicly, there were some problems with it, and they were problems that were like, some problems were easy to fix, right? Problems you could fix in a few days, problems you could fix in a few hours, but a couple of the biggest problems were, again, reading and writing, reading from the blockchain, writing to the blockchain, right? Data ingestion, order execution. We had some pretty bad technical debt that had built up from rushing the initial product out, and we had all this ambitious stuff we wanted to launch in November. We built it all. We had it in, a staging environment. We looked at it and we're like, this is not going to fly. This is not good enough. What's the problem? We realized there was a lot of technical debt built up, again, for reading from the blockchain and writing to the blockchain. So for the last couple months, we went in, cleaned it all up, made it very good. And now we're like, okay, we've, done the hard labor of fixing the problems. It's not live yet. What else do we want to do? And then we layered a few things on top. One of the things I sort of preached for the longest time was the concept of like DeFi abstraction. I think we're the only product that talks about this in the like this trading niche. But effectively, like for instance, on our platform, there is no mention of liquidity pools. Contract addresses are tucked away. There is no mention of the underlying protocols or dexes. It's just tokens, right? You just go token page. No mention of a radium, or no mention of the liquidity pool supporting it. Just the tokens. And we wanted to take that several steps further. And we were like, how do we abstract away the chains themselves? How do we make this product look and feel exactly like a fintech application? That was one of the things we were looking at for this new version as well. But just generally, like, if I had to boil down the most important parts, instead of systems getting a big rework, we tinkered with how the fee structure works quite a bit. I won't say anything beyond that, but it'll be very nice. And then in terms of like speeds for both data and execution, that's getting a full facelift. It was simply not fast enough. That's pretty much the long story short. But yeah.
Yep. Okay. I imagine you're quite bullish on DeFi as a trend, especially as it relates to like traditional finance. How do you see DeFi edging its way into TradFi? What's the process by which that comes online? Because I think that's like a pretty firmly held concept for a lot of DeFi guys that are like, no, this is, and I mean, it is better than shit on TradFi. Like TradFi, you have T+1, T+2 settlement where you buy and sell a fucking stock, and then you have to wait a day for it to clear, and then you have to wait another day or two for someone to let you move it. Yeah. Move those funds into a bank account. Like it does feel ridiculous. Like if I go onto a stock trading app, which I barely do, it feels like I'm back in like the early 90s in terms of like trading or just investment experience. So how do you see that shift like occurring, and on what timeline do you see guys in TradFi being like, oh fuck, there's something here, people want this is way better?
Yeah. I think one thing people sort of don't realize, now obviously a lot of folks in crypto maybe realize this, some maybe don't, but traditional finance, this is stuff, this is tech from like the 80s, right? This is ancient at this point, for 40-year-old plus technology. of course, like one of the things where I think a lot of people get jaded in regards to crypto is they're like, why hasn't the adoption picked up sooner? It is going to take a very long time to replace those rails. They are very deeply integrated. They're very hard to pull out. They're very expensive. There's a lot of incentive to keep them in place because it means control and it means, these other sorts of things. But I think that, on-chain becoming the new technology standard for finance is inevitable. On some time horizon, whatever it is inevitable. There's a variety of reasons for this, but I think like the canary in the coal mine here is Larry Fink talking about, tokenizing everything. Now, I don't know how much traditional finance understands about, I'll call it on-chain rather than DeFi. I actually do believe that over the next, decade or so, it's going to become less and less of the D and just the, on-chain finance effectively. But when he talks about the tokenization of every financial asset, and we have things like Bitcoin ETFs being spun up, and we have this pro-crypto, White House, and we have all these different sorts of tailwinds, we're not going to see overnight anything change all that much. It's going to happen very slowly, and it's going to happen through financial institutions, not through consumers. I think, I do think that we're going to see some headway with consumers, but not in the sort of ways that are at like, on the trillions of dollars scale. That happens by going to like either beating legacy incumbents at their own game or getting them to adopt this new technology. I don't know which is going to happen, but it's probably going to be a mix of both, right? Like internet companies didn't kill every analog business. Now they killed quite a few, but a lot of analog businesses adopted, to the internet. It's something similar will happen with traditional finance. I don't think there's ever going to be an aha moment. I don't think it's ever going to happen, in the next year, 2 years. It's going to be a very slow burn, and it's going to start again with a mix of consumers and institutions, much similar to the internet. I always compare it to the internet because if you look at like 90s internet, it was a bunch of hobbyists and tinkerers. It was borderline unusable. It had some utility, right? You could look things up and you could sort of chat with people and you could send emails and, whatnot. And obviously, with computers, you could, it's spreadsheets and other sorts of tooling on them. But 90s internet was, again, this sort of like 70s personal computing, right? Like when Apple first came out, it was considered unbelievable to have a computer that people could use in their home. That was considered ridiculous, right? Like, and a lot of it was just these sorts of really nerdy, very technical folks that didn't want people like, coming in their territory, right? It was like, this is for us, this is for me, nobody else should have access to it, like screw you. And the internet, followed a similar trend. Every new technology follows this trend. Crypto is going to follow it as well, right? Like 7 years ago, a lot of the or 6 years, or however long ago, 2017, 2018, the mentality then was like, again, ETH maximalists, everything should be perfectly decentralized. It was very idealistic. It was very, it wasn't about things like adoption. It wasn't about things like let's onboard everybody. It was about, again, idealism. And I think that Solana sort of broke that mentality and is now saying, no, throw all those things out the window. This is about adoption. And it's sort of become more pragmatic and more, what's the absolute end state of crypto? It's not about having a perfectly decentralized system. That part, can, of course, will play into it. It's about getting people to actually use this stuff. And I follow a similar thought process. It's like, well, this technology is only as useful as however many people use it. Like if you have the perfect, fastest, cheapest, most decentralized blockchain and nobody uses it, what does it matter, right? Versus, okay, you have a more flawed blockchain, but at least millions of people use it. That's a far better outcome, I think. So yeah, crypto has been a lot of hobbyists and tinkerers. It's a lot of science fair projects. It's not, not a lot of it is grounded in reality. It is like the 90s internet as it's like 70s computing, right? It is these things are all very similar to one another. And of course they all follow the same path is eventually these people, eventually products come out that sort of break these people's model of the world. They go and actually make the technology useful versus, just keeping it to themselves. And then of course you see a real boom, but that's sort of how I think it's going to play out.
Man, science fair project is I'm going to borrow that. It's a good way of describing a lot of the protocols that come online. You're like, who's using this? Like someone had a lot of fun making this and you can tell someone was really into it. And I'm sure there's tech in it that will be useful at some point. But yeah, in terms of actually gaining an everyday user. It's like hyper obscure, very niche. You wonder what the PMF is, and you just know some guy has like devved the shit out of it and being like, "Fuck yeah, this is amazing." And it's like seven people.
Solutions in search for problems, right? Solutions in search for problems. Yeah.
Yeah, I think that is one thing that Solana has done incredibly well in the last 18 months. You know, regardless of like your moral or ethical take on it, they've delivered shit that people actually want to use at scale. So
Hyperliquid
I know that,
as well, right?
Yeah, exactly. Hyperliquid. I know that you guys are on up. That's actually a good question. How do you view yourselves in like comparison with something like Hyperliquid? Are you concerned about those guys kind of taking the lunch money, or what's the go there?
No, I love Hyperliquid. I admire them a lot. I think you know what I love about Hyperliquid, and then I'll answer your question in a sec. But I love Hyperliquid
No,
because it broke every model that people had in their heads for how crypto businesses should work. Right? They, purposely made some trade-offs for the sake of UX. They didn't raise venture capital. They didn't launch some pre-PMF token. They waited till they were like the number one perp dex. I think they had like some 50 some odd % market share, and then they launched the token. The token behaves in a way like an equity, right? It's fundamentals driven. It's based on volumes. It's based on fees. It's based on revenues. And it completely and the other thing too is they built a chain with like, I don't know how many developers there are. I'm assuming like sub 20. But they built this chain without needing hundreds of millions of dollars in funding, right? They pretty much destroyed the entire like the entire model in people's heads for how like how DeFi businesses will grow to scale. They completely threw that out the window. Again, no venture funding, destroyed the perpdex market, verticalized the business, now launched a chain faster than some other chains who have hundreds of millions in funding, have been building their stuff for like 3-4 years or more. But yeah, no, in regards to Hyperliquid, I see like, the real difference is that Hyperliquid is focused on protocols and infrastructure, right? It calls itself, I don't remember what it was, like the blockchain for all of, or the house for all of finance, right? The blockchain for all of finance. Hyperliquid is an infrastructure play, and it's a very good one at that too. I think that, even though we have the Hyperliquid app, right? In reality, the app is not what made it successful. What made it successful was the protocol underneath the app, right? It wasn't the front end. It wasn't the application itself. It was the protocol. In our case, like, we never want to be a protocol. We're strictly an application. We're strictly focused on consumers. We're strictly focused on user acquisition. And we could, take something like Hyperliquid, plug it into our product as is, and help serve that to more people. I think there's sort of this like, there's this sort of like misconception in crypto. I don't know what you would call it. There's this, I don't know what the word would be, but every protocol is trying to be an app, and every app is trying to be a protocol. I think that like you should sort of separate the church and state here, where there should be teams exclusively focused on building apps, exclusively focused on user acquisition, and then of course teams exclusively focused on things like financial infrastructure, transaction fees, liquidation engines, optimizing liquidity and optimizing the quality of AMMs, and all these different sorts of things. I think that when you commingle the two, which is what we've been doing, you end up with, in the last 7 years, it's been protocols building apps as like a second thought. Those apps being borderline unusable by populations at scale. And now we have teams coming in, effectively trying to be pure apps. And it's still like the very early days of this, but I think that's the real difference. Hyperliquid is infrastructure. It's financial infrastructure. It's good at financial infrastructure at that too. So. Yeah.
Shit. All right. I need to go buy more hype. I feel underexposed. Immediately.
It's a good long term. I'll put it this way: like, it's very rare you see a team in crypto make billions of dollars and then that not being the end goal, right? Like Hyperliquid, those guys have more money than they know what to do with, and they're not saying, okay, we're done here, let's go buy our cars and houses. They're saying, wait. If we can make this much money now in something that's nascent, imagine how big of an empire we could build if we stuck it out, right? I think that's one of the other problems with crypto is people. The end state, the end goal is always just money. It's never about legacy. It's never about building things for long term. There's never a thought for, what is this going to look like in 10 years? It's just about how do I make as much money as fast as possible right now. And then you end up with, nothing is scalable, nothing has staying power, so on and so forth. But yeah, they're going to be around for a while.
Yeah, that is a very refreshing thing about Hyperliquid is it did put a big middle finger up to the kind of like VC raise, spend 3 years building some junk that you kind of half deliver on and then eventually promise a token at some point, and everyone's kind of like, oh, and they get some huge exit and they're like, actually, yeah, I'm retiring. I'm going to go buy a fucking super yacht. Sorry.
Yeah, exactly.
Fantastic. So you guys are on Ethereum, Base, Arbsol. Which chain sees the most activity, and why do you think that is?
Yeah, it's absolutely Solana. There's a few reasons for it. What people will say is, the reason Solana is successful is because it's fast and they subsidize gas costs, right? It's cheap. Yes, it is fast and cheap, but that is not the exclusive reason why. Part of the reason for Solana's popularity is people sort of like, anytime something is successful, people find a way to discredit it. I think this is just like a natural, I do this too sometimes, right? Everyone does this. But with Solana, the reason why there's so much volume on it, and the reason why there's so much volume on the chain itself, it's not just because of the cost. It's not just because of how fast it is. It's because Solana has enabled an entirely new asset type. In fact, the meme coin that breaks traditional financial models, right? Fintechs, centralized exchanges, they cannot actually capitalize on this opportunity. You cannot list like 50,000 tokens a day that are launching, right? And a lot of people will look at that and they'll say, oh, this is worthless garbage. This is just a casino. This is stupid, right? They'll say any number of things. But the truth is this, meme coins have been around since the dawn of crypto. In fact, I think that, like, do you know what the word meme actually means? It means, it's from effectively the concept of memetics. A meme is a unit of information. It is not an image of a dog. Like, that's what we know it as now. It's been sort of bastardized. But a meme is a unit of information. And I think that really Solana being fast and cheap, that made the user experience closer to parity with centralized exchanges. But why is there so much volume on Solana? It's because those tokens, those assets are only tradable on chain. You cannot go to alternatives and trade them reliably. And if you do go to an alternative like a Coinbase, like a Binance, you're only going to get a handful, sub 0.001% of access to the same assets that you have when you go directly on chain, where you get access to all of them. And I think that, I'll go on a quick tangent about meme coins. I think that people have the idea completely upside down in their heads. It is not strictly gambling. Yes, it is a new form of speculation. Yes, a lot of these things are like inherently valueless. But what I pose to people is the question, like, one thing people say is, meme coins have no fundamentals. And one thing I always ask people is, well, how do you define fundamentals? What is that, right? Because for a venture, let's give an example, like a venture business pre-revenue. If you don't have revenue as a metric to look at, what are the fundamentals for that business? There'll be other things, right? Like user count or growth or who the team is or how much, whatever it is. And I think that every single asset in finance, people think of fundamentals as the static object, as this thing that's true of every single one, but that is simply not true. You do not look at the same information for each to assess the value of them. The other thing as well is that fundamentals vary based on market participants, right? Your opinion of what makes hype valuable may be very different than what my opinion of what makes hype valuable. And there is no clear-cut definition for fundamentals. So then the question I ask people is, if there is no clear definition for fundamentals, then who's to say that meme coins don't have fundamentals, right? You could look at things like the number of unique holders, how popular these memes are on social media, if they represent like an event, like when Trump got shot, there were a bunch of Trump shot tokens. You can look at the stature of that event, how popular it is. It's effectively a way to invest and bet on, honestly, it's like memetic viruses, right? Or internet trends, or whatever you want to call them. And there are certainly fundamentals associated with these things. This is an entirely new asset class. It is very primitive right now. It is very early, but this is like the general trend of finance, I think. And it started with NFTs, or really it started with crypto. NFTs just were like this failed form factor. Now we have meme coins. We also have things like predictions markets. Effectively, the question people are trying to figure out and ask and answer is, how do I put a price on anything, no matter how abstract or how granular, whether that's an image or a video or an event or a tweet or a meme or whatever. That's what was uniquely enabled by Solana's low transaction fees, by their fast block times. Was now you have something at parity in terms of speed and cost with centralized exchanges and other fintechs, and at the same time it enables this entirely new asset class that these old products, these legacy incumbents, cannot capitalize on. That is why Solana has gotten so popular. Very long answer to your question, but yeah.
No, I very much fuck with that. It's literally just trading attention. Like you live in an attention economy, and it's like, why not? Again, I'm sure there's so many people that have fucking moral qualms with it of like, no, you can't just tokenize it. It's bad. We shouldn't financialize everything. But it's like, well, it's happened. The toothpaste is out of the tube. Like it's being done, and it will probably continue to be done. You don't have to partake. You actually don't have to get involved. You can go buy DeFi tokens if you want. That's fine. But there will be a market for it. There is a market for it, and it'll continue. Yeah. Okay.
Yeah, and I guess one thing I'll quickly add to this is people have moral qualms with it, but everything in this universe has value. And in like every human, when we assess like say decisions, or when we think about whether we're going to do something, whether we're going to talk to someone, whether we're going to whatever it is, right? We look at a news headline, we look at a tweet, we assess the value of that thing in our heads. We love to categorize and label stuff. We assess the value of everything, every moment of our lives, everything we do, whether we take a meeting, whether we send an email, whether we like a tweet, we assess the value of it. What is the difference between that sort of mental model and ascribing price, which is really just a standard for value? There is no difference. The only difference is that now you have a market around it where other people can contribute, their opinions of how valuable they think this thing is. But that's really the only difference. Everyone participates in this system, whether they like it or not. This is just the way we operate. Meme coins are sort of like pointing a mirror at us. That's the truth. Yeah.
Yeah, I like the mirror analogy. We were speaking before, talking about how like Wall Street may be actually more aligned with DeFi than Silicon Valley. How's that kind of panning out now that the tech side is shifting away from the DeFi side of things, and it's looking more like it's going to be aimed at like traditional finance or that kind of thing?
Yeah. I've seen this firsthand, right? Like I'm in the Valley. I'm in San Francisco. All my friends work in, one guy is building a semiconductor chip company. Another guy makes solar panels, right? There's obviously like, the people around me understand what I'm doing. They appreciate it. It makes sense to them. But most people I engage with in tech hate crypto. They hate it. And this happened because this was FTX. This was the fault of FTX. FTX made a lot of these Valley investors look dumb. They scammed, these firms like Ribbit and like Sequoia. And I don't even know who all they took money from. Paradigm, I guess, was another one. But after FTX, the Valley said, we want nothing to do with this. And I'm sure there were other companies as well that people got burned on, but they're like, we want nothing to do with this. We don't want to be involved with this. We don't want to be affiliated with this. We're throwing it out the window. And then, finance comes along and they say, okay, well, now that the tech hype has died down, now that this initial boom bust has happened, we're going to come in and take advantage of it. And, obviously there's like really only a handful of, I'd imagine there's a very select minority in finance that understand this stuff, number one, and are excited about it. But that's all it has to, be to start. Of course, like, crypto today has effectively, the home base of crypto today has moved from what was SF in like the mid 2010s to now New York. This is not just by coincidence. This is because of finance coming and saying, okay, you're our thing now. And the ETFs were like the clearest signal of that, right? They're like, okay, we're going to throw our reputations on the line for your chief asset, Bitcoin, right? But yeah, I think finance, the chief duty of financial institutions is not, they don't care about perception, they don't care about optics, they don't care about the things the Valley might care about. All the finance cares about is finding opportunities and making money. That's the entire like duty of the financial system, and they obviously see an opportunity here, and if they didn't, they wouldn't touch it, right? Yeah.
Okay. No, that is the nice thing about when you start layering it out of like the branding, marketing, advertising, almost like egoistic side of tech side. You start to just get to like really clear, transparent self-interest from the financial side, which is refreshing in a certain kind of way. Speaking of like the egoistic side, Donald Trump's now the president. I think a lot of people were initially a lot more bullish on his election and what it would mean for like a regime change over at the SEC and just like on the regulatory front more broadly. It hasn't gone too well for markets at the moment, but I mean, that's just Trump slapping tariffs on everything and being like, fuck it, we're going to repay the national debt. What's your thoughts around how things go from here? Like, I think Paul Atkins just got confirmed to the SEC. He's obviously a big pro-crypto guy. I think there's going to be a lot more stuff like that just gradually come in the following months. And I think it's one of those like early side signals where people are watching and being like, okay, when does this translate to market action? When does this translate to actual net positives for the industry? What's your thoughts on that?
Yeah, this is everything happening now between tariffs and all this other stuff. All of this is good for crypto, and I'll explain why. So obviously, with the tariff scare, with any financial scare, the first assets to go are the most risky, right? As an investor, what are you going to sell first? You're going to sell the riskiest stuff. So obviously, crypto saw quite a bit of a downturn in end of January, early February, about 2 months ago now. However, all of this stuff, like, what does all of this signal, right? What do tariffs signal? What is the threat of Jerome Powell being fired signal? What is the threat of people realizing just how much control the executive branch has over the U.S. financial system signal? It signals effectively like crypto has always been like an inverse bet on nation-backed currencies. That has always been that was the whole pitch, right? Was let's create these safe haven assets that are disconnected from any nation. They are not affiliated with nations. If one country falls, crypto remains. If the U.S. dollar goes away, crypto will still remain. But effectively, all of this is leading to weakened sentiment in the dollar because of the fear that we thought when we set up the financial system, we sort of thought of the Fed as this autonomous unit that controlled the economy and the monetary supply, and was uninfluenced by the executive branch, and therefore the president was less powerful than people may think. But of course, over the last few months, Trump has showed us that is certainly not the case, right? The executive branch has far more power than anyone realized. To be able to change tariffs overnight, snap your fingers, say 200%, that signals, okay, wait, this economy is more centrally controlled and more centrally planned than any of us realize, which isn't inherently a problem, but it does mean that the checks and balances put in place that supposedly made the U.S. economy more fault tolerant than it is are not actually realistic and true. So all this is good for crypto. Between lowering regulatory barriers and between weakened dollar sentiment, weakened U.S. economy sentiment, it does sort of lend credence to crypto as an entire industry, as an ethos, as a whatever you want to call it. But I think that the lowered regulatory barriers it's sort of a double-edged sword, right? So if you are like an early or mid-stage business, a lot of the reason why early stage startups in DeFi and crypto were able to flourish was because of this regulatory ambiguity. You could take advantage of grayness that legacy incumbents were unwilling to touch. Publicly traded companies would not touch, right? Now, of course, when you lower those barriers, it means, all right, a lot more financial activity, a lot more financial interest, a lot more money moving to the system, but it also means that legacy incumbents can come and with their distribution, with their means, and with their power, and with their whatever, can come and capitalize on the opportunity that they otherwise were unwilling to touch. So it's a double-edged sword. It means that something like Robinhood could enter DeFi like tomorrow, but it also means, oh, nice, Robinhood's users would be onboarded to DeFi. So right, so yeah, it depends on your perspective, but all this stuff is good for crypto. It's just, it may not be immediately apparent, but over the next 5 years, 10 years, it'll be pretty obvious.
Okay. How do you think Robinhood's going to make a proper charge into crypto in the next couple of years?
Yeah, they're pretty clearly signaling this, right? Like they made a wallet, I think like a year ago or two. They've been listing more assets. I think, I don't know what their user count is, but they're obviously a very large company. They're publicly traded. They have a lot of means. And now that the regulatory barriers are gone, their chief goal as a company is to expand, right? And to get bigger and to make more money. So, crypto is still sort of the Wild West, but now there are there's less red and yellow taping. So yeah, I have no doubt they're going to enter crypto a lot stronger than they may have been, willing to in the past. There's zero doubt in my mind. Now the question is like, how are they going to do that? What's the form factor? What's it going to look like? I have no clue.
No, yeah, like the two big boys like Robinhood and Coinbase. I think there'll be a bit of a war of attrition there for user mode. What kind of products? I think Coinbase is probably positioned more like advantageously, at least just for on-chain shit. That's if Jesse Pollack doesn't, destroy the base brand first. But yeah, how do you see the rest of this cycle playing out? I know that we've had a lot of theories around, it was really right translated, the top's in. I definitely think the top's in for certain classes of assets. But yeah, how do you see the rest of this moving? Do you think blow off top late 2025, or is it just more of a slow grind up? And which assets do you think are kind of best suited to capitalize on this regulatory shift that we're seeing as well?
Yeah, obviously I have a very biased take on all this stuff, but
no, I like it. It's a safe space for bias, man. You're good.
Yeah, I very biased in this, but I have a sort of crazier theory in that I don't think that 4-year cycles are going to be a thing anymore. I don't think it's going to track things like Bitcoin halvings. It's going to, loosely track it. But the truth is, like, every industry that reaches some scale has an initial boom bust, right? Now, for tech, that was the .com bubble. We had that huge boom bust, right? In crypto, like, people say, 2017, 2018 was a boom bust. Then we had 2020, 2021, that was a boom bust. And we have this new thing now. No. The only true big boom bust where, the tide pulled out, billions and billions of dollars were lost, was 2022 and 2021, or whatever you want to call that. What just happened with, the tariff scare and, markets sort of settling, no companies really imploded. We did not see any FTXs. We did not see any 3Arrows. No Celsiuses, no BlockFis, no nothing like that. We saw some weird stuff get uncovered, right? Sort of some of the stuff around like how meme coins were launching and, some other seedy practices. But nothing like the market is still pretty healthy. And I think that we're never going to see the same sort of fervor that we did in 2021. We're never going to see that much money inflow that fast. We're never going to see that much venture spending happen that fast. We're not going to see that many new businesses created that fast. It's going to be a very slow trend up over the next, many, many, many years. And I think that the businesses that are best suited to capitalize on this are ones that, like, again, I'm biased. I think apps are going to continue to grow in terms of revenue percentages. When we first started the business, apps made, I think, like, less than 10% of all on-chain revenues. They're now at like roughly 60%. I've always had like a fat app thesis approach to building. I think that, like the internet, apps will dominate. I think that the only businesses that will survive over the next several years are ones that solve a real problem and make money, right? It's as simple as that. If like the whole, infrastructure token thing, like that just didn't work. We're seeing that infrastructure has become heavily commoditized at this point, and the value is accruing pretty sharply to just a handful of chains, right? It's really like Ethereum has all the TVL, Solana has all the volume, Base sort of, Base and BSC are sort of like the, those are the horses for Coinbase and Binance respectively. And then we have, sort of Arbitrum, and now I guess we have Hyperliquid, which is, Hyperliquid EVM is to Hyperliquid, what BSC is to Binance. So that's sort of another one of those. And then there's a steep drop off after that. So yeah, I think that like assets like Hyperliquid or Radium or Solana or these assets that do represent like, a stake in a very valuable protocol will continue to be good over the next many years. I think that businesses that prioritize things like revenue and, prioritize survival and prioritize things like adoption, like actual metrics versus playing a game of musical chairs are obviously, the better ones to bet on. And I think, beta plays like Robinhood stock or Coinbase stock is also a fair way to play it. Yeah, I think this is going to be a much more boring industry over the next several years. That's what I think. It's going to get a lot quieter.
Yeah. Okay. No, I can agree with that. Like, I think that's something that we saw with LLMs as well. Of like, oh, value will accrue back to the base level LLM, and it's like, no, it's the fucking wrappers, it's the storefronts that made all the money. It's these like little spin-offs of things that address really, really specific niches, that address really specific problems and capitalize on it quickly. Similar shit with trading bots and with that kind of product side on crypto. Obviously, the base token does well when you have high volume of like activity and high volume going across the chain. That's just going to be a natural second order effect. But it is these endpoint things like pumped up funds, like trading apps that actually kill it and actually hit revenue because they're focused on that. And that's where the users are ending up, rather than just like, I'm going to buy a lot of the native token and just sit in it. It's like, no, you're going to fucking use it if you're actually on chain and participating. So yeah, I'd like to finish things up with kind of a shitty question, but what do you, if you have to pick one thing for each category, what are you most bullish on and most bearish on heading into the next year or two?
Yeah, I'm very bearish on anything that says let's use blockchains for things other than financial activities. All right, I it's not that it can't happen in the future, right? Like video games or IP or any of this stuff. It's not that it can't happen. It's just that until the most basic things the system promised work, we cannot get ahead of ourselves, right? Like I think it's very silly to say, okay, these financial ledgers, even though they're not good, and even though we haven't like actually scaled the financial part, let's start having other information written in these chains because, for whatever reason, there's never a good reason I was given, but I'm very bearish on anything that falls into that bucket, right? I think like, to be honest, like I think that a lot of crypto investors, especially on the private side, unfortunately are like, it's going to take they're always like a lagging indicator, right? But I think it's going to take them some time to recalibrate to this new system where it's going to look a lot more like software in the valley in the 2000s, right? Where, in the 90s, you had all these crazy companies promised to people. You had, I don't even know what was being pitched in the dot-com bubble, just crazy stuff, right? And it's hard to come down from that high where, in the 90s, like in 2021, everything was possible and nothing wasn't, right? But unfortunately, reality set in. There are very real limitations to the technology. So things like, again, it's not that DePIN can't be a thing. It's just like, okay, why would we start looking at things like DePIN when we still haven't solved the most basic fundamental problems, which are this has to work as a financial system first before anything else. So I'm very bearish on anything that like doesn't take into account first steps first, or first things first, whatever you want to call it. And I'm very bullish on anything that does. So that's pretty much it. This is a financial system first and foremost. If you try to overcomplicate that, if you try to moonshot it, like the fact that we're replacing the old financial system is a moonshot in and of itself. We don't need to start doing things like on-chain metaverses and these like AGI on-chain, all this stuff, right? It's like we can do it later, let's get the first order stuff correct first. But yeah,
I could fuck with that. I like it. That's probably like one of the best answers I've had to that question. It works.
Good, glad.
No, it works really well directionally. Of like, hey guys, how about we solve the shit that's directly in front of us instead of trying to build like a fucking house of cards on top of it and be like, see, it kind of works. We're using blockchains for stuff. Yeah.
Yeah, exactly.
Yeah. Dude, awesome, man. Mate, where can people find you on the socials? Where can people stay up to date with what you're doing? And what have you got coming up next? Like, what are the big stuff that you'd want to point people to go check out if they're listening in?
Yeah, I have a Twitter. It's just at Jackson Denka. That's my Twitter. And then as of what's coming next, we've been really quiet the last couple months, but we have this new version coming out that I think is going to be. I won't say anything specifically, but it will be quite a step up from what we have currently on the market. I feel pretty good about it. Put a lot of work in. We took a lot of effort to do these upfront investments that'll pay off over the next 6-9 months, and I think it'll be something pretty special. But yeah.
Okay. Fuck yeah, dude. Awesome, man. Thanks so much for coming on the show. Appreciate having you on.
Thanks for having me, Tom. It was fun.